Hi there, welcome to Kneppy Invest. It's one of my favourite times of year, if not the favourite time of year, August, as we experience companies releasing their full-year results, or for some companies, the half-year results. Not all companies will release their results because there is a wide range of differing reporting seasons for companies on the ASX, but we'll say a vast majority of companies will release some form of results during August. So I'm going to do a few videos on smaller cap companies and looking at their results. And the first company I'll be looking at is Scali, simply because it is actually one of the first companies to release their results. Corvist, I've done a video on that company before, releases their full-year results towards the end of July, but Scali released their results in the first week of the month. And if you've been a shareholder of this company for the past 10 years, you have seen your holdings in this company explode during that period. In fact, your returns would have been about 20% or maybe even larger than 20% per year over the last 10 years. And that's exactly what sort of returns you want to have holding a company for the long term. So this definitely is a company that has been a wealth winner for its shareholders over the past 10 years. And the question is, can it continue to be a wealth winner for shareholders over the next 10 years? So we'll both explore their past and then also look at their future. Before we delve deep into Scali's financial year results, just a few facts in regards to this furniture well, I'm not sure if they manufacture furniture, but they definitely import furniture from overseas and sell that to their customers. I actually did go to their website, and on their website, they did have a letter to their customers in regards to some shipping issues that a lot of companies around the world are facing right now, and delays in importing furniture from overseas. And those delays were 12 to 16 weeks. And I thought that could be affecting Scali's performance, because I would have thought a lot of people, when they order stuff, they like to receive that stuff almost immediately. They don't like to wait 3 or 4 months before they actually receive whatever they bought. But it doesn't seem like it is affecting Scali's performance in recent times. Ticker code for Scali, NCK, and the market cap $1 billion at a share price of $12.59. One really good thing about Scali is they don't dilute their shareholders. So if you go back 10 years ago, the shares on issue was 80.1 million shares, and now it's 80.1 million shares. So shares on issue haven't been going up or down. That's really good, because the management of this company are not diluting their shareholders, and that's a massive tick in my book. Now let's look at some of the financial year 21 results for Scali, looking at revenue, operating cash flow, and net profit after tax. Also have a look at like-for-like revenue increases. I do like to look at that like-for-like, because if you don't know what like-for-like is, that's just looking at the stores that were in existence 1 year ago and just looking at the revenue increases of those stores, ignoring all the new stores that have been opened up in the past year. And we have a 34% increase in revenue in these like-for-like stores over the past year, and overall increase in revenue of 42%. Now in isolation, that looks really good, but this whole sector has seen significant tailwinds behind their performance in the past year, because, and this is just my opinion, we don't have absolute facts in this, a lot of people who would be spending a lot of money traveling overseas have instead used that money to increase or improve their household furniture, renovations, that sort of thing. And in the next few years, I'm more than likely what we'll see is a lot of those people who have spent a lot of money on improving their household, buying new furniture, kitchen renovations, will more than likely spend money on traveling overseas. There is that possibility we might see this sector see significant decreases in the revenue and performance than what we've seen in the past year. That's something we have to be mindful as shareholders or potential shareholders in a company. But overall, revenue, operating cash flow, and net profit after tax have increased substantially for Scali. Operating cash flow up 80% on financial year 20. Net profit after tax up 100% on financial year 20. You can't see those increases in those operating cash flow and net profit after tax and think that's going to continue into financial year 22 and financial year 23. If you are thinking that, I think you're going to be highly disappointed by Nick Scali's results in financial year 22 and even financial year 23. I have had a look at some analysis thoughts on their performance, Nick Scali's performance in financial year 22 and financial year 23. And they are expecting a significant decrease in earnings per share. In fact, 25 to 30% decrease in earnings per share. And right now, earnings per share is at $1 per share. So they're talking about earnings per share being around 70 to 80 cents in financial year 22. And I'll talk about that in the next few slides and how that could affect the share price moving forward. Some investors and professionals I know completely ignore the past performance of a company. And in a way, they are right, because the market is forward-looking. The market wants to know how a company is going to perform over the next 5 to 10 years. And it values the company based off that future potential performance. They don't care about the past. But I do think you can get some clues how a company is performing and may perform in the future by looking at the past. And you definitely will see that with some companies' performance over the past 10 years. And I've included here a chart of Nick Scali's financial performance in terms of revenue, net profit after tax, and cash flow from operations in half-year increments over the past 10 years. And we see a consistent growth in revenue. We see a consistent growth in net profit after tax. We see consistent growth in operating cash flow. Revenue has grown from $62.9 million to $171 million. Net profit after tax has improved from $6 million to $40.6 million, and operating cash flow has improved from about $5 million to $67 million. So we're seeing a consistent growth in the financial performance of this company. And the question we have to ask ourselves is whether they can continue this momentum over the next 5 to 10 years. And that is the big question we have as investors and potential investors of a company. One task I like to do for most companies I'm doing a little bit of research on is to look at the revenue, operating cash flow, and profit growth over a certain period of time. For Nick Scali, that's the last 10 years. And just compare that to the valuation growth of the company over the same period of time. For Nick Scali, I'm using market cap, and I'll use market cap for most companies, in fact. And the reason I'm doing this is I want to know why the share price or valuation of the company has increased over that period of time. And there's two reasons why the share price or valuation can increase for a company. And the first way is because of financial performance of that company. So if the financials, the operating cash flow, profit have been growing through time, the market cap or the valuation should grow with it or very close to it. But there is another reason why the valuation of a company can increase through time, and that's called multiple expansion. And the best way to look at multiple expansion is the market willing to pay more of a premium for a company's shares? A perfect example of this is Apple. When you compare the share price in 2016 or the valuation in 2016 to right now. And if you look at the P ratio of Apple in 2016, it was something ridiculously low, like 12 or 13. And that's the main reason Warren Buffett bought a lot of Apple shares back in 2016, because the valuation was quite low compared to the financial performance of the company. So the market was, in 2016, paying a discount to Apple shares. But over the past 5 years, the P ratio of Apple has increased from 12 to well over 30 right now. So over the past 5 years, the market is willing or more willing to pay a premium for Apple shares. And the risk with that is if the financial performance doesn't improve at the same rate as a multiple expansion and we see PE ratios keep going up, there's a greater chance that in future we'll see an underperformance in the share price compared to the overall market, because sometimes we'll need a financial performance of the company to catch up to that multiple expansion. We've seen that plenty of times in the past. I think It was Microsoft about 20 years ago. The share price did nothing for a long period of time because at one point in time, the PE ratio of Microsoft was really high. And then over the next 10 years, maybe 5 years, we saw the share price just go sideways, even though the financial performance of Microsoft was actually improving. And that's the risk you have. When you see the PE ratio of a company keep on increasing, that's multiple expansion. You prefer to see the valuation of a company improve because of financial performance, not because of multiple expansion. So that's the whole task I do right here and what I've done with Nick Scali in this table. I'm just comparing the operating cash flow and the profit growth over the past 10 years and just comparing that to the market cap growth. Now, I'm going to exclude revenue here because the margins in Nick Scali have improved over time. So even though revenue has grown from 100 million to 373 million, which is growing at 14.1% per year, the most important financial metrics for Nick Scali's performance is operating cash flow and profit. So operating cash flow has grown from 14.3 million to 140.4 million. Well, that's growing at 25.7% per year. That's a stellar growth rate for operating cash flow. Profit has grown at 22% per year from 11.6 million in 2011 to 84.2 million. Now let's just compare the growth rate of operating cash flow and profit. So we'll just say profit 22% per year. Now look at the valuation of the market cap of Nick Scali over the past 10 years. It's grown at 22%. Almost identical than the profit growth in this company during that same period of time. And that's telling me right now that the market is not paying a discount or a premium to Nick Scali right now than what it was 10 years ago. Ideally, what I would like to see is the valuation of Nick Scali only grown at 15-16% over the past 10 years compared to profit growing at 22%. That's telling me there's a bit of a discount or potential discount in Nick Scali's share price right now. And that means there's a greater chance that Nick Scali's share price will outperform the market over the next few years. The other thing I've done here is I've discounted what's happened in the past year because we've seen significant growth in the profit and operating cash flow because of some tailwinds behind the company. So I just wanted to see how the company was growing or grew from 2011 to 2020. And even then, when you discount the past year with all these tailwinds, the market cap or the valuation of this company grew at 16% per year and the profit grew at 15.4%. So again, the profit and the valuation were growing at very similar rates. So again, there was no discount or premium put in Nick Scali's share price. One place I really like to go to look at how retail sectors have been performing over time is the Australian Bureau of Statistics, the ABC website. And they do break down retail sales in individual sectors. And this one I'm looking at is household goods retailing because this is where Nick Scali falls into. And household goods retailing can be broken down into three distinct areas: furniture, floor coverings, houseware, textile goods. That's definitely where Nick Scali falls into. Also, another area is electrical and electronic goods. And the last one is hardware, building and garden supplies retailing. On the right here, I've just looked at June results for this certain sector. In fact, it's fell 1.3% in June, and the area where Nick Scali falls into, furniture, floor coverings, etc., fell 3.1%. So there was a little bit of strain or stress in this certain area where Nick Scali falls into. The chart on the left goes back 2 years. So this includes pre-COVID levels. And we can see the significant tailwinds this sector has experienced because of the COVID-19 pandemic. Pre-COVID, monthly retail sales in this sector was roughly about 4.5 to 4.75 billion per month. And because of COVID-19, that's increased to be between 5.5 $6 billion per month. That's why Nick Scali and other companies like Nick Scali have experienced some tailwinds. That's why the financial performance of these companies has really improved. And the question I have, and other investors should have, is whether these tailwinds can continue in the future, or whether we'll see retail sales in household goods fall to almost pre-pandemic levels. And if we do see the fall in retail sales in this sector, that could really harm Nick Scali's performance in the next few years. I'm going to show you two charts for Nick Scali. The first chart here is the monthly chart going back to 2011. In the next slide, we'll look at the daily chart over the past year. There are three distinct periods of time for the share price performance of Nick Scali over the past 8 years. And you'll see the share price increasing during the first period, share price going sideways during the second period, and then a massive increase in the share price during the third period. The first period was between 2013 and 2017. The share price of Nick Scali increased from $1.50 to $7.50. That's a six-fold increase in the share price over a 4-year period. And there are two reasons why the share price increased by six-fold during that period. The first reason was the financial performance of the company. But the second reason was there was a bit of multiple expansion. The market was willing to pay more of a premium to Nick Scali, particularly towards 2016 and 2017. In fact, we saw the PE ratio of Nick Scali go from its average, which is around 12 to 13, to a top of about 17 in 2017. And sometimes when you see a company's valuation increase because of multiple expansion, you get an increased risk that the company's share price will then underperform the market's performance over a certain period of time. And we definitely saw that with Nick Scali during its second period here between 2017 and the start of 2020 during the peak of the COVID-19 financial panic. In fact, the share price of Nick Scali went sideways. And during this period of time, even though the financial performance of the company was improving, the PE ratio actually went from 17 back to its long-term average of 12. And then the third period here is over the past 18 months since the bottoms of the COVID-19 financial panic. The share price has increased from $3.50 to a top of about $13. And the reason why the share price has increased like that over the past 18 months has been because of the financial performance of the company. The PE ratio has remained static around 12 to 13. So we've seen no multiple expansion in this company's share price during this period of time. It's because profits have doubled over the past year or so. And the question is, what's going to happen with Nick Scali's share price over the next year or so? If we get multiple expansion, we actually can see Nick Scali's share price improve or increase from here. But if it does increase from here, there is that risk that we'll see the share price go sideways over a certain period of time or even go backwards. And the analysis the professionals who do cover this company are suggesting that the profits and earnings per share of this company will fall 25 to 30% in the next year and then not really improve in financial year 2013. If that happens, there's a possibility we'll actually see a share price of Nick Scali fall back towards $9 so that PE ratio can remain at its long-term average around 12. And if it does fall between say $8, $9, that could be a good point to buy into this company. And finally, to Nick Scali's daily chart, which goes back to August of 2020. When Nick Scali did release their full-year results in August of that year, the market loved it. Share price rose, I think it was about 15% on that day. And the share price of Nick Scali has been in this well-defined uptrend since November last year. In fact, over the past 6-7 months, it's touched that uptrend about 3 or 4 times and keeps bouncing off it. And right now, the share price is at an all-time high at around about $12.59 right now, but has reached a high as $13. If I was a shareholder of this company, there's no reason to sell out because this uptrend is intact, hasn't been broken. Because I'm not a shareholder, I have no real desire to buy into Nick Scali right now because there's no discount to Nick Scali's share price at this point in time. If I saw the share price retreat back down to $8, $9, that would become more enticing to take up a parcel of this company, because I do think the future of this company does look bright, particularly if they can keep this momentum going that they've seen over the past 10 years. There's no reason why this company can't keep growing over the next 10 years. That's all I have for this financial year 21 results video for Nick Scali. Hope you've enjoyed it. And if you do have some opinions or thoughts about this company, particularly if they are different than mine, I'd love to hear them, because that's how I personally grow as an investor, by listening and trying to understand opinions that are different than my own. I'm not a financial advisor. If you do need to seek financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.